Have you ever wondered why the price of a company's stock seems to change every second, even when the company itself isn't announcing anything new? It's a quiet puzzle for many people, and yet it affects anyone who has a retirement account, a brokerage account, or even a casual interest in investing. The stock market doesn't operate on some hidden magic or secret formula. It's a reflection of human behavior, collective expectations, and very real financial decisions. Let's imagine a young professional living in a mid-sized city in the United States. She earns $60,000 a year. After taxes, that comes to roughly $45,000 in take-home pay. On paper, that seems like a comfortable salary. Rent for her apartment costs about $1,200 a month. Her car payment adds another $300. Student loans take $400, and other lifestyle expenses like subscriptions, groceries, and a few meals out consume another $800 per month. By the time she considers investing, her discretionary income is limited. She knows she wants to start investing in stocks, but the first question arises, how does she even decide which stock to buy and at what price? The traditional answer might be that stock prices are set based on the company's fundamentals, revenue, profits, growth potential. And while these factors do matter, they're only part of the story. Stock prices are determined in the market every day by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. That might sound simple, but behind this mechanism is a complex network of buyers, sellers, institutional investors, algorithms, and psychological factors. Imagine our young professional again. She's researching a well-known technology company. She reads the quarterly earnings report and sees solid revenue growth. On the surface, she might assume that the stock should be cheap or fair at its current price, but the market has already priced in expectations. Investors anticipate future performance, consider competitors, analyze macroeconomic indicators, and sometimes react to news or rumors. Even a slight deviation from expected performance can trigger significant price movement. Now, let's put some numbers to this. Suppose the company has 10 million shares outstanding, and investors collectively value the company at $1 billion. Each share would be priced at roughly $100, but that number is only as solid as the market's collective belief in that valuation. If suddenly investors believe the company will grow faster than expected, demand rises. More people want to buy at $100. The price rises to reflect the new equilibrium between buyers and sellers. Conversely, if investors fear future challenges, they start selling. The price drops to attract new buyers. In essence, every trade reflects someone's expectation of value, and those expectations constantly shift. Psychology plays a central role in these dynamics. Humans are not perfectly rational. We respond to news, follow trends, and sometimes react emotionally. Fear and greed are not just cliches, they drive significant portions of market behavior. Our professional might hesitate to buy a stock after seeing it rise sharply in the past week, or she might jump in after hearing friends talk about gains. These impulses create demand and supply imbalances, even if the underlying company fundamentals haven't changed. Price becomes a reflection of collective sentiment as much as financial reality. Beyond individual psychology, institutional investors and market makers add layers of complexity. Large funds can move millions of dollars with a single trade, influencing short-term price fluctuations. Algorithms execute thousands of trades per second, responding to minute signals that are nearly impossible for humans to track. For our beginner investor, these forces make the stock market feel unpredictable, even chaotic. But it's not random. It's a structured system responding to measurable inputs and human behavior. There's also the hidden system flaw many beginners overlook: short-term thinking. Many people assume that stock prices move solely based on company performance. They see a drop in price and panic, or a rapid rise and chase the trend. This short-term focus amplifies volatility and often leads to poor investment decisions. Our professional might invest $500 in a stock only to see it drop 10% in a single day. Without understanding why prices move, the experience feels unfair or mysterious, but it's a natural result of supply, demand, and collective psychology. Over time, ignoring this reality can have long-term financial consequences. An investor who buys or sells based on emotion may underperform compared to someone who understands market dynamics. Short-term fluctuations can lead to missed opportunities for compounding growth. For someone saving for a house, retirement, or other financial goals, this underperformance may cost tens of thousands of dollars over a decade. It's not about luck, it's about understanding how prices reflect the broader market environment and human behavior. So how do financially intelligent people approach this? They recognize that stock prices are signals, not guarantees. They focus on long-term value, not daily fluctuations. They analyze company fundamentals, market trends, and broader economic conditions, but they also accept that no prediction is perfect. They set clear investment goals, maintain diversified portfolios, and resist reacting emotionally to every market move. In other words, they align their behavior with the mechanics of the system rather than against it. For our young professional, this might mean starting with a broad index fund instead of chasing individual stocks. It could mean setting aside a fixed portion of her monthly discretionary income for investing and automating the process. It might involve keeping a small portion of her portfolio for individual stock exploration, but always with clear limits and research-based decisions. By separating expectation from reality and emotion from strategy, she can participate in the market intelligently without being consumed by its short-term volatility. Understanding stock prices is less about predicting the next big move and more about understanding the forces that create movement. It's about recognizing that every price reflects a combination of company fundamentals, market expectations, and human behavior. By seeing through the noise and focusing on systematic, informed decision-making, investors can make progress toward financial goals without feeling lost in the market's unpredictability. In summary, the market is a living system. Prices aren't arbitrary, but neither are they perfectly logical. They reflect the tension between what is known, what is expected, and what people are willing to pay. Beginner investors often struggle because they misinterpret short-term movements as permanent value changes. By understanding the mechanics, acknowledging psychological pressures, and acting with clarity, anyone can navigate stock markets more confidently. Continuing from our discussion, let's dive deeper into the mechanics of how stock prices are set and why understanding this is critical for beginner investors. The first thing to grasp is that stock prices are a negotiation between buyers and sellers at any given moment. Each trade sets a new price based on what someone is willing to pay and what someone else is willing to accept. Unlike a fixed retail price, the market is dynamic, and each participant contributes to the shifting balance of supply and demand. Consider our young professional again. Suppose she wants to buy shares of a popular technology stock currently trading at $100. She places a market order to buy 10 shares. If sellers are willing to sell at that price, the trade executes immediately and the stock price remains stable. But if there are more buyers than sellers, she might pay slightly more to get her shares. This process repeats for millions of trades every day, creating the constantly moving price we see on financial apps and websites. A subtle but important concept is that stock prices often reflect expectations, not actual results. Investors anticipate future earnings, potential acquisitions, new products, or economic trends. If the market expects a company to grow rapidly next year, the stock may trade at a premium today. Conversely, even a small miss in expected performance can trigger a sharp decline. For beginners, this can seem counterintuitive. Why would a company worth $100 per share suddenly drop to 95 if nothing has changed in reality? The answer is collective expectation prices are forward-looking, not backward-looking. Now let's put some numbers on it. Suppose a company earns $50 million annually and has 10 million shares outstanding. Its earnings per share are $5. A common valuation method might assign a price-to-earnings (PE) ratio of 20, suggesting a stock price of $100. But if investors anticipate faster growth, the market might apply a higher P/E ratio, pushing the price to $120. If growth slows, the ratio contracts and the price drops to $80. The underlying earnings are the same, but market expectations create the price swing. Psychology plays a major role here. Investors react not only to news but also to each other's actions. Fear can spread rapidly in a market downturn, prompting selling that pushes prices even lower. Optimism can inflate prices beyond what fundamentals might justify. Behavioral finance research shows that humans are prone to herd behavior, overreacting to short-term news and underreacting to long-term trends. For someone new to investing, it's easy to feel caught in an unpredictable whirlwind, but recognizing these patterns helps reduce unnecessary panic. Another important factor is liquidity. Some stocks have more buyers and sellers than others. Highly liquid stocks, like those of large technology companies, have many participants, which generally usually results in smaller price fluctuations for each trade. Smaller or less followed stocks may experience dramatic swings even with relatively small trades. For beginners, this highlights why starting with well-established, highly liquid companies or index funds reduces risk while learning how the market functions. The system also includes institutional investors, hedge funds, and algorithmic traders who move large sums of money at high speed. Their actions can temporarily shift stock prices in ways that individual investors may not anticipate. While it might seem unfair, these forces actually create more efficiency in the market over time. Prices adjust quickly to new information, meaning that in the long run, the market reflects collective assessment of value, even if short-term movements appear volatile or arbitrary. So how do financially intelligent beginners approach this? First, they separate the long-term signal from short-term noise. They understand that daily or weekly fluctuations rarely indicate permanent value changes. They focus on fundamentals, earnings growth, competitive advantage, management quality while using market prices to identify opportunities rather than as emotional triggers. Instead of buying a stock because it rose yesterday, they buy because the underlying business makes sense and fits within their investment goals. Risk management is another essential mindset. No investor can predict prices perfectly, so protecting capital is key. Diversification spreads risk across multiple companies, sectors, or even countries. Rather than placing all funds into a single stock with high volatility, a diversified portfolio ensures that individual price swings don't derail overall financial progress. For our professional, this might mean allocating a portion to broad index funds, another portion to individual companies she understands well, and keeping cash reserves for flexibility. Let's revisit the math. If she invests $500 per month in an index fund averaging a 7% annual return, compounded over 10 years, her portfolio could grow to roughly $80,000. Individual stock selection may add additional gains or losses, but the principle is clear. Regular contributions, patience, and understanding how prices reflect expectations are far more impactful than guessing the perfect moment to buy. Understanding volatility also helps manage emotional responses. Markets are naturally bumpy. Stocks can fall 10, 20, or even 30% in a short period without any fundamental change. For a beginner, this is uncomfortable, but not dangerous if investment decisions are aligned with long-term goals. Emotion-driven buying and selling magnifies losses, while calm, informed decisions create compounding growth. Over time, these behaviors separate successful investors from reactive participants. Education and observation are critical tools. Paying attention to how news affects prices, tracking simple financial metrics, and recognizing psychological biases help beginners build intuition. Our professional might notice that a company's stock drops after an earnings miss, but rebounds over weeks or months as fundamentals reassert themselves. She begins to understand that short-term price movement often reflects sentiment, not permanent value change. This awareness prevents unnecessary panic and fosters confidence in decision-making. Finally, it's important to remember that stock prices are not moral judgments. A high price doesn't mean a company is good, and a low price doesn't mean it's bad. Prices reflect the collective interpretation of value, constantly updated through millions of individual choices. Financially intelligent people internalize this principle. They use prices as information to make deliberate, rational decisions, not as signals for fear or envy. By aligning actions with understanding rather than reaction, they steadily build wealth and achieve long-term goals. In conclusion, stock prices are set through a combination of supply, demand, expectations, and human psychology. For beginners, the key is not to try to predict every fluctuation, but to understand why prices move, how expectations drive value, and how emotional responses can distort judgment. By focusing on fundamentals, practicing disciplined investing, and maintaining awareness of market psychology, anyone can navigate stock prices intelligently. It doesn't guarantee immediate profits, but it does provide clarity, reduces unnecessary stress, and enables steady progress toward financial objectives. Understanding how stock prices are set transforms confusion into perspective. Our young professional doesn't need to guess or react impulsively. She needs knowledge, patience, and consistent action. Over time, these habits compound into both financial understanding and tangible wealth creation. So, if this explanation has helped clarify the stock market mechanics and why prices move the way they do, consider subscribing. Developing awareness is the first step toward making smarter investment decisions that respect both your present and future goals.